Hello, Sawadee Krap, and welcome to this quarterly video of TSP Funds. This first quarter has been difficult for both equity and bond markets, with concern over the implications of conflict between Russia and Ukraine, rising inflation, and the potential risk of a faster pace in interest rate hikes by central banks. Volatility increased sharply, and all risky assets were negatively impacted, except commodities and, in particular, energy prices. Equity markets ended the quarter significantly down with two distinct phases. First, a strong rotation out of expensive, quality and growing companies which suffered from higher rates, notably in the US. Then in the second step, the war in Ukraine, impacting mainly European markets. The Thai equity market was resilient thanks to its higher natural value characteristics and a lower geopolitical risk. From a sector perspective, energy and to a lower extent utilities were the two only positive performers, all others being down, in particular technology stocks. Global bond markets were penalized by both strong rise in interest rates and a large widening of credit spreads. It is important to notice that US Treasuries did not play their usual safe haven role during the Ukraine crisis. In Thailand, the government bonds index was also down amid higher rates, while corporate bonds offer some resilience with slight positive returns.
In this volatile environment where all major asset classes fell, the TSP funds displayed negative returns in absolute and relative terms. The diversification across asset classes did not offer protection, as bonds, credit and equity went down simultaneously. Over the quarter, the TSP fund exposed to equity suffered the most. The main contributor was the allocation to cash, as well as the diversification on UBS China fixed income, and in equity, the value fund Schroder Asian Equity Yield performed well. On the negative side, fixed income fund largely invested on credit, such as PIMCO Income and Schroder Global Credit Income, were the key detractors, while the selection of equity funds, in particular Tisco Strategic, Amundi Fund Poland Capital Global Growth, and JP Morgan China, was also detrimental. Those funds that were top contributors during the past years suffered during the market rotation. More broadly, most of the long-term stock pickers were unable to outperform in this market driven by geopolitics and macroeconomics rather than by company fundamentals.
We see four main themes for the coming months. First, geopolitics and politics. We cannot predict the duration of the war, but its consequences will shape the economic and social features of Europe, influencing growth, fiscal and monetary policies, and opening new geopolitical challenges. 2022 presents a busy global electoral agenda also. Second theme, growth slowdown. We have adjusted downward our global growth forecast by 0.5%, but the revision is not homogeneous, and Europe is the most impacted. Overall, a global recession should be avoided. Third theme, persistence of high inflation. Inflation has been revised higher for 2022, and it may be fueled further by higher energy price, putting additional pressures on central banks. Finally, central banks' hawkish tone. We anticipate the ECB to postpone policy normalization while the Fed is expected to normalize on inflation trends. Nevertheless, the task of central banks will not be easy, and the potential for policy mistake is high amid the uncertain economic outlook and higher inflation. All these uncertainties around growth and inflation will decrease visibility of future market directions. Despite recent signs of stabilization, it is not time to re-enter the market aggressively. At this stage, we are still slightly cautious on equities and in particular on European markets, and we favor value, quality and dividend themes. On fixed income markets, the protective nature of government bonds in times of market stress incites us to be active in duration management. We continue to hold a short duration bias as rates remain too low in a persistently high inflationary environment. Finally, we are around neutrality on credit markets amid weaker growth, higher rates and higher inflation. Nevertheless, corporate fundamentals are strong and balance sheets remain healthy.
We have been active to adjust the investment strategy in this volatile and adverse environment. At the end of February, we turned to a defensive positioning on equity in order to protect portfolios. To this objective, we sold Eleva European Selection, as the region is the most impacted by the conflict. We also sold partially Goldman Sachs Global Core. After having raised cash to protect portfolios from a larger crisis, we decided to reduce our underweight in equity exposure in March. During the quarter, we also progressively increased our exposure to value stocks, as market style rotation should continue as a medium-term trend. We invested in Harris Associates Global Equity, a fund managed by a boutique specialized on value investments. We also bought an ETF focusing on USA value factor. On the opposite side, we reduced our exposure on Amundi Fund Poland Capital Global Growth. In Asia, we reduced our exposure to JP Morgan China due to concerns over the impact of China's zero COVID policy and the geopolitical context. On Thai equities, we turned more constructive and are now around neutrality. In this pocket, we reduced Tisco Strategic Holding and reintroduced KTAM Z50 to reflect our preference for larger capitalizations. Within global fixed income, we reduced our credit exposure by selling PIMCO Income and Schroeder Global Credit Income. We reinvested partially on two funds, mainly invested in government bonds, PIMCO Global Bonds and a Global Aggregate Bond ETF. In China, where we now expect a slower growth and a mild depreciation of CNY given COVID restrictive measures, we took our profit on UBS China fixed income. Finally, on Thai fixed income, where we are now overweight, we reinforced the allocation on safe assets, in particular on K-Cash. To conclude, unpredictable events drove the evolution of financial markets in the past weeks, penalizing in the short term our selection and the TSP funds. Financial markets regularly go through stressful phases. It is particularly important not to overreact and always keep in mind the following rules that are particularly relevant in times of market turmoil. Diversify your investments, stay invested and respect your investment horizon, continue to invest regularly, and select the best investment experts. We thank you for your support and attention, and we'll meet you again for the next quarterly video of TSP Portfolios.
TMB และธนาชาติเปลี่ยนเป็น TTB เปลี่ยนเพื่อให้ชีวิตคุณดีขึ้น